How to make money online from index funds. What's an index fund, you ask? Well, it's another technique that we're going to share with you to help you earn passive income. Index investing has been around for decades and is a simple strategy that many investors use to diversify their portfolios. What's really amazing about index investing is the wide variety of ways it can be done, including on platforms like Wealthfront, Betterment, and Vanguard. If you're looking for a way to make money online, then be sure to hit subscribe and hit that notification bell so that we can help you on your journey. Mutual funds and exchange-traded funds, ETFs, aim to match the return of an index and known as index funds. What is an index fund? Thousands of indexes are kept track of the changes in sectors and markets on a daily basis. They're used to evaluate the health and performance of that market. An example of an index is the Dow Jones Industrial Average. This is a market index that includes 30 blue-chip corporations. The index can also be used as a market standard or a metric for measuring performance. You can't buy an index directly, but you may invest in a fund that follows the index. The majority of index funds track the same market by accumulating all of the components of the index. A fund may approximate the index with a sample of the securities or with future derivatives such as options and futures. Passively managed exchange-traded funds, ETFs, are an excellent way for investors to gain exposure to a market without taking any undue risk. They typically keep what's in the index to maximize gains and minimize expenses. Here are a few examples of index funds and what each one tracks. Vanguard 500 Index Fund, VFIAX, 500 of the largest companies in the US. iShares Russell 2000 ETF, IWM, 2000 US small cap stocks. Fidelity Sustainability Bond Index, FNDSX. Environmental, social, and governance criteria are all being addressed by bonds. There are hundreds of indexes, some of which only have a few firms and others that include thousands. How do index funds actually work? A mutual fund is a type of mutual fund that invests in assets such as stocks and bonds. A mutual fund pools investors' money and invests it in securities like stocks or bonds, with the goal of generating returns for investors. A fund manager is in charge of making buy and sell decisions for a mutual fund. An index fund is a mutual fund that tries to mirror the results of a certain stock market index. A market index is an imaginary portfolio constructed from the market's components that depicts a proportion of the market. What happens when you invest in an index fund? When you invest in an index mutual fund, your money is combined with the money of other investors. The fund manager utilizes that money to buy equities, bonds, or other financial items that make up the index it tracks. A manager may or may not invest in each component of an index, but the goal is to obtain a representative sample of every item in order to track the index's performance over time. There are also index ETFs available. ETFs, which are traded on exchanges rather than through a mutual fund firm, are similar to stocks in that you buy and sell them. You aren't sending your money to a mutual fund company when you acquire an ETF. Instead, you're buying the investment directly from an investor who is selling his shares. If there is a surplus of shares, new ones can be generated if demand outspaces supply. The end result is essentially the same as investing in an index mutual fund. Benefits of index funds. If you buy into a fund, you should expect the same rate of return as the index minus fund management expenses. In most situations, index funds have superior returns than actively managed investments. The portfolio of an index fund seldom varies. This consistency lowers trading costs and taxes. There is no need to pay fees for portfolio managers or stock investigators, since the fund does not require frequent trading. An index tracking the ever-changing oil and gas sector, for example, may be more of a risk than a fixed income index fund due to its holdings. Because they just keep what's in the index, these funds are always visible. This allows you to make a better assessment of an index fund's risk based on those holdings. Rather than buying single stocks, you may buy portions or hundreds of thousands of companies at once to build your own portfolio. This diversification minimizes risk. If one stock or bond is down for the day or a year, another is likely to be up. Negatives of index funds. Because its aim is to track the index, the fund generally keeps the same securities and holds them regardless of market conditions. During a broad market decline, the fund manager can't sell stocks that are lagging behind to avoid losing money. Because of their inflexibility, index funds are unlikely to return more than the benchmark. When the market or sector rises, you're assured of the index's return. However, when the market falls, you're also guaranteed of its loss. The difference between an index fund's return and the performance of its parent index reflects the cost of running a portfolio. A tracking error is the same term used to describe this. When comparing index funds that track the same index, always choose the one with a smaller tracking error. The problem with stock market indexes is that they are inherently subjective. They're designed and built by firms who choose the index's components. The decision-making process isn't tightly controlled. It's not always clear, and it can be influenced by overall management techniques. Sometimes the index funds and the index have the same managers. How much money can I earn? Investing is for the sake of long-term financial advantage. You'd have approximately $60,000 today if you started saving $5,000 per month at the start of the decade and invested it in a low-interest savings account. That sounds great, but inflation is a silent killer of your cash as your purchasing power becomes less over time. However, if you invested your money in an index fund such as the S&P 500 over the same period, the S&P 500 has returned 225%, meaning that a $500 a month strategy over a decade would have returned you around $120,000 today. How do you choose an index fund? Before you invest in an index fund, you should consider a number of factors. First and foremost, how much risk are you willing to take for the potential return? What are the risks involved with the fund you're considering? Is its approach in line with your investing goals? What is the maximum amount you'll pay for buying, owning, and trading the fund? Compare different funds and their transaction costs, as they might differ significantly. Also, how quickly will you need the money, as this is a long-term commitment? Are index funds good for you? Index funds and ETFs consistently outperform actively managed funds. Some of them can be quite lucrative, but they aren't all made equal. Therefore, do your research. You could discover your own solutions or require the assistance of a financial advisor. So, how do you invest in index funds? You'll need a brokerage account or an ISA to invest in index funds directly. You can place an order for either an ETF or a mutual fund that tracks your target index once you've found a way to invest. How many should I buy? The amount of index funds you own should be determined by the diversification of the indexes. If you invest in well-diversified funds, you may only need one or two. If you invest in targeted funds that track specific industries, then you'll need many to construct a comprehensive, diverse portfolio. You might also put the bulk of your money in a well-diversified fund, while keeping a tiny amount to experiment with various specialized sectors. How much cash do you need to put into index funds? With as little as a few dollars, you may get started investing in index funds. It's not smart to invest more than you can afford to lose, especially if you don't have emergency money set aside. Do you have an investment in an index fund? Let us know what you're holding in the comments, and if you're looking for a few good starting places, then check out our description below the video. If you found this video useful, why not hit the like and subscribe for more strategies on how to make money online.